welcome listeners. In today's session, we will discuss the types of GDP and the critical correlation between GDP and the stock market. Please refer to my previous podcast for an introduction to GDP basics. To begin with, there are two types of GDP, real and nominal GDP. To understand its meaning, let's delve into the distinction between nominal and real GDP. Let us imagine the economy as a photograph. Nominal GDP is like a snapshot capturing the total value of a country's goods and services at current market prices. It's a straightforward view of the economy at a specific time. While real GDP, on the other hand, is a more detailed picture. It's like a time lapse, showing the total value of goods and services a country produces over a period but adjusted for inflation. This adjustment allows us to see the proper growth of the economy beyond the effects of price changes. Calculating nominal GDP is straightforward based on the current market prices of goods and services produced. However, real GDP is a bit more complex. It's calculated based on the market prices of a specific year known as the base year. This is because real GDP aims to measure economic growth, which requires adjusting for inflation. This adjustment is crucial as it allows us to see the economy's true growth beyond the effects of price changes. Also remember that real GDP is often considered a more accurate measure of economic performance than nominal GDP. Now that we have understood the different types of GDP, let's explore how it relates to the stock market or not. Understanding this correlation can provide valuable insights into economic trends and investment opportunities. So there are two types of markets in the stock market universe. First is bull market and second is bear market. First, let us consider the bull market scenario. A bull market is a term used to describe a situation with rising equity markets. It is crucial in influencing financial conditions and consumer confidence, affecting the gross domestic product, that is GDP. During a bull market characterized by rising stock prices, there is generally an optimistic outlook on the economy and the potential of various stocks. Also, there is one more point to focus on, and that is when companies need to raise capital, they can issue new shares. These can help them expand their operations, invest in new projects, and hire more workers, boosting the GDP. Also, higher stock prices lead to more consumer conviction and increased spending, which can result in significant purchases such as homes, automobiles, etc. This leads to increased sales and earnings for corporations, further boosting GDP. Now, likewise, consider the bear market scenario. Conversely, when the stock market is falling, which is typically a characteristic of the bear market, it means that stock prices are going lower, which can harm market sentiment. For example, when the world saw a recession in the year 2008, the stock markets across the globe dived and were seized by bear markets. Let us look at some crucial factors affecting the bear market and GDP. In a bear market, investors hurry to sell stocks to prevent losses. Typically, those losses lead to a withdrawal in customer spending, mainly if there is also the fear of a recession. So now understand the correlation. When people spend less, companies earn less money. These can force companies to cut costs and lay off workers. The decrease in spending can be worsened by more people losing their jobs and feeling unsure about the future. These can lead to even less spending and investment, ultimately hurting the economy. The fact is that both the above scenarios explained are looking at GDP and the stock market in a traditional way, which is that they both move in the same direction. But to everyone's surprise, in recent years, we have seen that there is a reducing correlation between the two. Let us see the example here. Consider going back for a few years. When the world saw a recession in 2008, the global stock markets plummeted and were gripped by bear markets. However, recovery was seen in the country's GDP from 2009 to 2011. The same was reflected in the stock markets too, and they recovered for a short period before falling again due to a rise in crude oil prices and other factors like inflation, the debt crisis in Europe, etc. This decrease in stock markets was confirmed by a decline in GDP. Versus today, In recent years, especially post-COVID, the world has seen a decrease in GDP due to several global lockdowns and other contributing factors like rising crude oil prices, breakdown in global supply chains, the Russia-Ukraine war, Iran-Israel conflict, etc. Major economies are contracting and about to face severe recession, but stock markets in some of these countries are increasing. Take the case of India. While the global economy giants are seeing a slow increase or decrease in their GDPs and volatile stock markets, India's GDP is slowly returning to its pre-COVID levels. The IMF is also of the view that India will largely remain unaffected by the global recession scare. On the other hand, the stock markets are pretty optimistic and are seeing bullish trends. I hope the fundamentals of GDP are clear to all of you. In the comment section, please mention how you found the episode. What do you think about the correlation between GDP and the stock market? I would appreciate it. I am Manali signing off. Thank you for listening to FinPod and have a happy weekend, everyone.